Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary as a basis for this market update. So let's jump right in and take a look at the market, how the market performed last week. Here we can see the S&P 500 was down 1.7%. That's quite a large loss for the week. The Canadian stock market was also down quite a bit, but not as much as the US. It came in at 0.9%. Last week, we didn't see a lot of reports coming out to drive the market, but investors were generally concerned overall of the possibility of the Federal Reserve tapering down the road. So investors pushed the stock market lower last week. On Friday, we did see the PPI, the Producer Price Index, come out, and it came in at 8.3% ahead of a consensus of 8.2%. Now, 8.3% is quite a large number. And investors got a little skittish from that, and we saw the large stock market drop on Friday as a result. This week, on Tuesday, we're expecting to see the CPI, the Consumer Price Index, come in at 5.3% on a year-over-year basis, which is quite a large number. It's going to be interesting to see how investors react to this number. Last week, we did see HAC make some changes in the portfolio. It covered its short sell position in the industrial sector and flipped that over into the material sector as well. It initiated a small position in the global uranium index sector as well. Now, the uranium sector tends to have a strong seasonal period that starts in late September, early October, and runs into January. This year, we've seen the uranium actually pick up quite a bit ahead of its seasonal period. And that's largely been because of the introduction of the Sprott Physical Uranium Trust Fund in mid-August. It's attracted quite a bit of investment. And because it's a physical fund for uranium, when investors buy into the fund, it's actually the fund actually buys the physical uranium. So we've seen a little bit of a price squeeze taking place ahead of the strong seasonal period for uranium. If we take a look at what's going on in the markets, we can see here that overall, well, here's the S&P 500 as our bogey here, a reference point, down 1.7%. It's interesting that we don't see, this is the growth sectors here. This is the cyclical sectors right here, and this is the defensive sectors right here. And we don't see a huge discrepancy where money moved all one way last week. In fact, what we saw last week, we saw some sectors do well one day and then did not do well the next day, and back and forth and back and forth. So a lot of sector volatility, not a really strong outperformance from the growth sector or growth sectors or the cyclical sectors or even the defensive sectors. Now, we did see the consumer discretionary sector actually with a smaller loss, much smaller than the market, and the communication services as well. Also, not quite as much as the U.S., the S&P 500. Now, the technology sector was down 1.7%, so approximately at market. Now, industrial sector was down quite a bit, 2.5%. But if we take a look at the material sector, it was down 1.6%, and energy down 1.7%, and then we got financials down at 1.3%. Now, the big loser of the week was the real estate sector, down 3.86%. Now, the previous week, the real estate sector was up over 4%. So we've seen a lot of flipping back and forth overall on this. Consumer staples down 1.3%, healthcare down 2.7%, and also utilities down 1.5%. So where do we stand right now with the markets this week? Well, there's not a lot of news coming out this week. Although we do see the CPI numbers coming out on Tuesday, the expectation is a 5.3% year-over-year growth rate for the CPI. If we see a miss on the high side, that could scare investors because Powell's been talking about inflation being transitory, and if inflation comes in higher than expected, that could scare investors. And if we see a miss on the downside, that could actually help investors get a little breathing room and lower the expectation as far as the Federal Reserve tapering sometime in the future, and maybe put that runway out a little further. I think the miss on the high side has more potential to move the market than on the downside as well. Now, on a seasonal basis, on average or long term, the last 2 weeks in September tend to be the weakest 2 weeks of the year. Now, so far, the S&P 500 has been negative for the month of September. We are coming into options expiry on this Friday, so we could see some volatility taking place, and we are coming into that weaker time for the stock market the last 2 weeks in September. So this is a time to be exercising some caution. Thank you very much.